have Surabhi Marwah, Partner People Advisory Services and Private Client Services from EY, joining us to talk about filing your advance taxes now. Surabhi, hi, and thank you so much for joining us. I just want to understand, to start the conversation and to set the tone right, what is the kind of things that people should be looking out for those who have still not started paying advance tax? Because still, if you look at it, the compliance rate is not as high.
Correct. Thank you so much for having me on the show. I think a couple of things that people should look out for are, they should estimate what their personal income is, beyond and in addition to what they earn as salary. So let me break this up into a salaried and a non-salaried person. For a salaried person, you don't have to worry about the taxes on your compensation or salary because your employer is doing a TDS or a month-on-month tax on it. It is the other things such as interest, such as rental income, such as dividends if you have them above a certain amount, that you should be aware of. You should accumulate those. You should go online and you should print something called a Form 26AS, which talks about how much is the amount of income you've earned on all of these sources, how much is the TDS the banks and the payers have already deducted. Calculate all of this on an annual basis and then make sure that the tax calculation and the amount that you're stipulated to deposit. So advance taxes are paid in 4 installments, July, September, December, and then in March. Make sure that you calculate the advance tax. Make sure that the 75% that you are liable to pay by 15th of this month is paid for and in time. If you have a one-time kind of income like a capital gain, you've sold something, then make sure that from the time that you've made that sale and from the time that that income has come in, you start estimating that and paying the advance taxes for that as well. So in a nutshell, gather all sources of your income, look online at your Form 26AS, see how much TDS has been deducted, do a calculation, reduce the TDS, and if you have a tax payable which is more than 10,000 rupees, after giving all of these credits, then you must pay according to the 4 installments. If you don't pay according to the 4 installments, please remember that the interest is charged not only for a day or 2 days or 3 days of delay, but it is charged for the entire quarter. So you may think, oh, I've forgotten to pay on the 15th, I'll pay on the 20th of December and I'll have only 3 or 4 days of interest. But interest is calculated for the entire quarter. So you'll end up coughing up a lot of interest. So the only exception for this 10,000 rupee rule I told you was for a senior citizen who doesn't have income from a business or a profession. But for all of us, we should do that estimate.
Are the rules any different for those who are running a business or are self-employed?
The rules are not different. The only difference is that they don't have a compensation income. So they don't have this whole bit about a TDS being done by the employer. So when they do their calculation, they will have to look at all their sources of income, including any business and professional income as well, and then calculate the advance taxes.
Okay, all right. If one does sort of evade paying an advance tax, is there any kind of penalty or any case or any kind of action that can be taken against them?
So there is an automatic interest that is levied, which is 1% for every quarter of delay. And as I was telling you, what people don't realize is that it's not done on a one-day basis. If you forget an installment, you are charged for the entire quarter. So that interest is automatic. And if you try and not pay it, but then you file your tax return, the tax, the way our online and our tax return system is that they'll ask for dates of payment of advance tax. So the minute you put the date, if you haven't paid the right amount of advance taxes, they will the facility, the ITR facility that we have will calculate the interest automatically, and the interest is under sections called 234B and C. So the 234B is done if you haven't paid 90% up till March, and 234C is if you haven't paid according to the 15, 45, 75 and 100% norms which are given for the 4 installments. So this is going to be automatic. You can't get away with the interest.
Can you talk to us about what happens to businesses or to taxpayers who opted for, for the scheme under Section 44 ADA? Is that any different from advance tax?
So that is a presumptive tax. So the difference only is that it's a presumptive tax mechanism, and in a presumptive tax mechanism, it's said that you calculate the taxes and the net income based on a certain proportion of expenses and deductions which are mandated in the particular section. So it is not the difference is not in terms of payment of advance tax as such, but the difference is how you calculate the total taxable income if you are if you are following presumptive taxation and if you are not following presumptive taxation. Very important to note also is that under presumptive taxation you need to fulfill certain criteria which depends upon the business, it depends upon what sector you are in, and various other things. So very important to note that even there you need to make sure that the taxes that are coming in are paid in time to avoid interest and penalties.
Surabhi, we have a lot of queries coming in as well, especially from retired personnel and people who are at the last leg of their employment tenure. Can you talk to us about whether even retired citizens are supposed to pay an advance tax, whether they're employed or running a business? Senior citizens in case of
the exception to payment of advance. Okay. The only exception for payment of advance taxes are if you are a senior citizen and you do not have a business or a profession. So if you are retired and if you are a senior citizen, then no, you don't need to pay advance taxes. But if you are a retired senior citizen who has a business income, for example, you're doing your consulting and you have any other business, then the advance tax provisions which we just talked about, 15, 45, 75, 100, they still apply to you. And the only other exception is if your income after taking into account all the TDS etc. done by the bankers does not exceed 10,000 rupees. Besides these 2 or 3 exceptions, there is no exception for advance tax for the category of people that you mentioned.
Surabhi, what are the exceptions, just for the benefit of our viewers, if you could highlight that as well?
Okay, so so 3 exceptions. If your amount does not exceed 10,000 rupees after taking into account any tax deducted at source, etc., then you don't need to pay advance tax. So if your net taxable income minus TDS is not more than 10,000 rupees, no need to pay advance tax. If you are a senior citizen and you do not have income from a business, you do not need to pay advance tax. Besides this, there is no other exception.
Okay, all right. And what are the avenues? I mean, of course, there are some authorized banks that have partnered with the Reserve Bank of India, etc. But what are the various sources that people can pay up?
So there's a physical mode in which you fill out a challan or a TDS deposit form and then you go and physically deposit it with the bank. That's long drawn. You have to give a check. It takes some time for the check, to get the stamp because the check needs to be cleared. The easier way is that you just go online, go into Google. You just need to type in payment of advance taxes. You will get the official link mandated by the Indian Income Tax Authorities. You go on to that link. It's a very easy process. It gives you 2 or 3. It has a window which says which challan to use. What is the code you need to file under. You have to select the right assessment here. It then links you to it gives you 2 options. One is with the bank, which is your NEFT, or you can use your debit card. But there are certain banks which are part of the NEFT and certain debit cards. And if you are using one which is part of that listed number of banks or debit card, then it takes you to the portal and that's it. It's paid. You get a challan instantly.
Surabhi, let's address some of our viewer queries as well. First up is an email. Sanjeev Singh has written to us. He's asking if a salaried person needs to pay an advance tax as the employer because the employer is already depositing TDS amount at regular intervals. So over and above that also, if the employee needs to pay up.
Okay. Mr. Singh, I think I had addressed this as we started the show. If your only means of income is salary income, and if your employer has done a month-on-month TDS, which they should do, then you do not need to pay any advance tax, because your entire liability of tax is taken care of by the employer through the means called TDS. If, however, you have any income which is beyond salary income, like I said, interest, dividend, rental, capital gains, then yes, you need to pay advance taxes, unless of course it is less, in your entire income other than salary is less than 10,000 rupees. So for a person who has only salary income and his employer has done TDS, then you have nothing to worry about. Then the advance tax there is nothing to pay in terms of advance tax.
Okay. Moving on to our next email query then, we've got an email from Pranay Jain. He says, what are some of the lesser known investments which can be made in order to save taxes? Because he already has exhausted Section 80C, and while calculating advance tax, does he have to know, does he have to take into consideration the 80C deductions as well?
Okay. So I'll answer your second query first, Mr. Jain. If you have already exhausted the limit of 80C, which is 1.5 lakh rupees a year, while doing the TDS, or the employer has already taken that into account, then even if you make additional investments under Section 80C, they are not going to help you with any taxes, because your limit has been exhausted. You can invest only for the purpose of investment, but there is no two separate buckets of 80C. 1,50,000 is the total limit. If the employer has taken it into account while doing TDS, you will not get an additional benefit of 80C. What you can do beyond 80C, 2-3 very important things you should know. There is a deduction that is available for medical insurance premium. You can take a medical insurance policy and you can get a deduction of starting from 25,000 rupees to a lakh of rupees, depending upon the age and the status of your immediate family, your spouse, children, and your parents. So it is a combination of senior citizens and individuals, and it can range from 25,000, as I said, to 100,000 rupees. That's one avenue you can look at. The other very good avenue is investment or contribution to a national pension scheme. Now, if your employer is doing that, then you can go ahead and make a contribution on your own. It's called the employee contribution. And you can get an additional deduction of up to 50,000 rupees in the year, which is on account of employee contribution to the National Pension Scheme. Even if your employer has not opted for that as part of your compensation structure, you can go ahead and contribute privately as well. So that's a good 50,000 rupees you can take into account into a market-linked kind of pension scheme. It's called the National Pension Scheme. So these two are very popular. The other one is, if you, it's not an investment, but if you're looking to buy a property and you're looking to take a mortgage, then you should know that any interest payable on mortgage is also allowed up to 200,000 rupees. It can set off from your salary income and potentially help you to reduce taxes to that extent. So it's not an investment, but it can help you to reduce and plan your taxes in the right manner if you've taken this mortgage. So these are three that you should definitely look at and can consider.
Okay, let's move right on to our email number 3. Vishal Kaushik writes to us, says, I want to know regarding LTCG and STCG tax treatment from STP from liquid debt to equity fund. Is there any difference in LTCG and STCG if both debt fund and equity funds are from the same AMC, or in the case of a different AMC? Could you give some clarity on that, Surabhi?
Okay, sure. Mr. Kaushik, the tax treatment is not dependent on the AMC. The shifting of AMC is a more practical, question, and you can call your AMC, and to my understanding, shifting can happen, but I think it's best to check with them. In terms of long-term and short-term capital gains, our tax rules differ whether it is depending on whether it is an equity-oriented fund or a debt-oriented fund. Now, in your case, you're shifting from a debt to an equity-oriented fund. Every time you shift from one STP to the other, it is considered as a redemption of that fund, and redemption is subject to capital gains. Now, in your case, because it's the debt fund that you're going to redeem and put into the equity fund, you will have to follow the rules which are applicable to the debt fund, which are that if you hold it for less than 3 years, it's short-term capital gain. If you hold it for more than 3 years, it's long-term. For less than 3 years, it's the same slab rates that you pay for any other income, starting from 31.2 to 42.74%. And if it's for more than 3 years, it's 20% with indexation. So whenever you're doing your redemption, please take into account, or your your STP as you call it, you should take into account the fact that there will be a tax incidence, because it's pretty much a redemption. And depending upon what type of fund you move from, debt to equity, equity to debt, you will have to follow the tax treatment of the fund that you're moving from, the original fund that you're moving from to the next fund. So I hope I have answered your question there.
Well, I'm sure you have, Surabhi. Thank you so much for chatting with us and for helping our viewers out as well, more importantly.
No worries.
Great to have you on the show. With that, we're going to slip into a short break, but when we come back, we'll talk real estate and the trends that are emerging not just in India but globally as well with Knight Frank.